Have you ever wondered why the smartest people in the room always seem to lose everything when markets crash? Like, literally. Doctors, lawyers, successful business owners, people who are brilliant in every other part of their lives. And then suddenly, they're bankrupt. Here's what nobody tells you about economic bubbles. They're not random, they're not unpredictable, and they're definitely not about people being stupid. Here at Simple Money, we've spent countless hours studying every major bubble in history, from tulips in the 1600s to crypto in 2021. And today, I'm going to show you the exact psychological pattern that creates every bubble and why they always collapse. Because here's the thing. When you hear about the housing bubble or the dot-com crash, it's easy to think, well, those people were just greedy. They should have known better. I would never fall for that. But that's not what's happening at all. Let me paint you a picture of what most people think. They hear economic bubble, and they imagine a bunch of idiots throwing money at obviously worthless things, paying millions for tulip bulbs, investing in companies with no revenue, buying houses they clearly can't afford, and they think, that would never be me. I'm smarter than that. I can see through the hype. Wrong. Completely wrong. The truth is, bubbles don't feel like bubbles when you're inside them. They feel like opportunity. They feel like the future. They feel like everyone else is finally catching on to something real. And the smartest people? They're often the ones who lose the most. Not because they're dumb, but because they're smart enough to build sophisticated justifications for why this time is different. Here's what makes this so dangerous. We've been taught that markets are rational, that prices reflect real value, that if something is expensive, it must be because it's worth it. But that's not how it works. Not during bubbles. During bubbles, prices become completely disconnected from reality. And the disconnect happens so gradually, so smoothly, that nobody notices until it's too late. Think about it. In 2006, houses in some neighborhoods were doubling in price every year. Every single year. And people looked at that and thought, well, that's just how it is now. That's the new normal. In 1999, internet companies with zero profits were valued at billions. And investors thought, we're in a new economy. The old rules don't apply anymore. In 2021, digital images of cartoon apes were selling for hundreds of thousands of dollars. And buyers thought, you just don't understand the technology. This is the future. Same pattern, different assets, same outcome. Let me explain what I call the greater fool theory. Here's the thing about bubbles. Everyone knows, on some level, that prices have gotten ridiculous. Deep down, they know it can't last forever. But here's the trick. They don't care, because they're not buying based on real value. They're buying because they think they can sell it to someone else for even more. The greater fool. It's like a game of hot potato. Everyone knows the potato is burning, but as long as you think you can pass it to someone else before the music stops, you keep playing. Think about flipping houses in 2007. People were buying properties they'd never even seen. Not to live in, not to rent out, just to sell 3 months later for a profit. They didn't care what the house was worth. They just cared that someone else would pay more. Or day trading meme stocks. Nobody thought GameStop was fundamentally worth $300 a share, but they knew other people were buying, so they bought too, planning to sell before the crash. This is the foundation of every bubble. Not stupidity. Not even greed, really. Just the belief that you can get out before everyone else does. But here's the problem. Everyone thinks they're smarter than everyone else. Everyone thinks they'll see the top coming. Everyone plans to sell at the peak. And that's mathematically impossible. This brings me to what I call the social proof spiral. Humans are social creatures. We look to others to figure out what's normal, what's safe, what's smart. And during bubbles, this instinct goes into overdrive. Your neighbor just made $50,000 flipping a condo. Your coworker just doubled their money in crypto. Your brother-in-law just bought his third rental property with the profits from the first two. And you start thinking, am I missing out? Is everyone getting rich except me? Maybe I don't understand something they do. This is how bubbles accelerate. It's not about fundamentals anymore. It's about FOMO, fear of missing out. The pain of watching others win while you sit on the sidelines. And the longer the bubble goes, the stronger this pressure becomes. Because the people who jumped in early are making real money. They're buying new cars, taking exotic vacations, bragging about their returns. So more people jump in, which pushes prices higher, which creates more success stories, which brings in even more people. It's a feedback loop, a spiral, and it's powered entirely by social proof. But here's what makes this particularly cruel. The people getting rich early, they're not smarter. They're not better investors. They just got lucky with timing. They bought early in the bubble. But they don't think that. They think they cracked the code. They figured something out. They have some special insight or skill, and they tell everyone about it. Not to be malicious, they genuinely believe it. They've built a narrative where their success proves their brilliance. So when you hear their story, it sounds convincing. They're not some reckless gambler. They're a successful person who made a smart bet, and it paid off. Why shouldn't you do the same? Now here's where it gets really interesting. What I call the narrative takeover. During every bubble, there's always a story. A compelling narrative that explains why this isn't actually a bubble. Why the high prices make perfect sense. Why anyone who's skeptical just doesn't get it. In the housing bubble, it was, they're not making any more land, and everyone needs a place to live, and housing always goes up in the long run. In the dot-com bubble, it was, we're in a new economy, and these companies will change everything, and you can't value them with old metrics. In the crypto bubble, it was, it's digital gold, and the dollar is dying, and decentralized finance is the future. These narratives aren't completely wrong. That's what makes them so dangerous. There's a kernel of truth in each one. Housing is limited. Technology does change things. Digital currency has real potential. But the narrative takes that kernel of truth and extrapolates it to absurd conclusions. It justifies any price. It explains away any concern. It reframes skepticism as ignorance. And the narrative spreads like wildfire. Because people who own the asset become evangelists. They have a financial incentive to convince others. And they have cognitive dissonance pushing them to defend their choices. Pretty soon, the narrative becomes consensus. It becomes common wisdom. It becomes, everyone knows. And anyone who questions it gets shut down. They're called old-fashioned. They don't understand the technology. They're stuck in the past. They're going to miss out on the opportunity of a lifetime. This is how bubbles protect themselves. Through social pressure. Through narrative control. Through making skepticism feel dangerous. But here's the uncomfortable truth. What I call the math always wins. No matter how compelling the story, no matter how strong the social proof, no matter how long the bubble lasts, there's one thing that never changes. Math. And the math is simple. If prices rise faster than incomes indefinitely, eventually nobody can afford to buy. If investment returns exceed economic growth indefinitely, eventually you've claimed all the wealth in the world. If everyone's getting rich, eventually there's no greater fool left. The bubble has to pop. Not because people lose faith, not because something external happens, but because the internal logic becomes impossible to maintain. Think about it this way. If houses double in price every year, in 10 years a normal house costs as much as a small country's GDP. That's not sustainable. That's not even possible. If everyone's making 30% returns by flipping assets, where's that money coming from? It's not being created. It's not being produced. It's just being shuffled around. And eventually, the shuffling stops. This is what people miss. They think bubbles pop because of some trigger, a crisis, a scandal, a crash in another market. But that's not the cause. That's just the moment when everyone realizes the math stopped working. The bubble was already over. People just didn't know it yet. And here's the really important part. You can't time it. Nobody can. Because the moment the math breaks isn't obvious. It happens gradually. Then suddenly, and by the time it's obvious, it's too late. Now, this next concept is particularly cruel because of how it traps even skeptical people. What I call the rational herding. Here's something most people don't understand. You can know it's a bubble and still participate. You can see the irrationality and still buy in. And it's actually rational to do so. Wait, what? How is that possible? Because if you're a professional investor, you get fired for missing returns. Even if you're right about the bubble, if you sit out for 2 years while everyone else makes money, you lose your clients, your job, your career. So you buy in. Not because you believe, but because you have to. Because the cost of being right too early is the same as being wrong. This is how bubbles trap everyone. The smart money knows it's unsustainable, but they can't afford to sit out, so they ride it, planning to get out before it crashes, creating more momentum. Making the bubble bigger. It's like a stampede. Once it starts, you either run with the crowd or get trampled. Standing still and being right doesn't help if you're crushed in the process. And this is why bubbles always get so big before they pop. Because the rational actors, the smart money, the people who should know better, they're all adding fuel to the fire. Not because they're fooled, but because they're trapped. Let me tell you about two people who experienced the exact same bubble completely differently. Meet Jason. Jason was a software engineer in the Bay Area in 2005. He watched as his coworkers started buying investment properties. Condos in Las Vegas, houses in Phoenix, places they'd never seen, never intended to live in. And at first, Jason was skeptical. The prices seemed high. The mortgages were complicated. Interest only, adjustable rate. Things that made him uncomfortable. But then his coworkers started making money. Real money. One guy made $40,000 in 6 months flipping a condo. Another bought 3 properties and was collecting rent that covered all the mortgages plus extra. Jason started feeling left out. Stupid. Like he was missing the boat while everyone else got rich. So in 2006, he jumped in. He bought a condo in Miami, never visited it. Used a subprime mortgage because he didn't have enough for a down payment. Planned to flip it in 6 months. The market peaked 2 months after he bought. By 2008, the condo was worth half what he paid. He couldn't make the mortgage payments. He couldn't sell without taking a massive loss. Eventually, he lost everything. His down payment, his savings, his credit score. Jason wasn't dumb. He was a successful engineer. He just got caught in the bubble at the worst possible time. He entered when everyone else was thinking about exiting. Now meet Lisa. Lisa was also in tech, also in the Bay Area, also watching the housing bubble inflate. She felt the same pressure, the same FOMO, the same social proof pushing her to buy. But Lisa did something different. She asked herself one question. If I was buying this to live in and never sell, would I be okay with the payment? And the answer was no. The houses she could afford were too far away, too small, too expensive relative to rent. If she was buying to live there, it wouldn't make sense. So she didn't buy. Even though it was hard. Even though everyone thought she was being stupid. Even though it felt like missing out. She saved her money, stayed in her rental, waited, and when the crash came in 2008, she had cash. She bought a house for 60 cents on the dollar, a house she actually wanted to live in, a mortgage she could actually afford. 20 years later, Jason is still recovering financially. Lisa owns her house outright and has built substantial wealth. Same market, same social pressure, completely different outcomes. Here's what most people don't realize about this whole pattern. Bubbles aren't natural disasters. They're not random. They're not acts of God. They're predictable human behavior amplified by systems that reward short-term thinking. The people who avoid them aren't more disciplined. They're not more rational. They just asked better questions. They focused on fundamentals instead of momentum. They were willing to look stupid in the short term to be right in the long term. And here's the key insight. In a bubble, being right feels wrong. Sitting out feels like losing. Watching from the sidelines is psychologically painful. But that pain is actually information. It's telling you that social pressure has overwhelmed logic. That narrative has replaced analysis. That you're being pulled into something dangerous. The people who succeed don't ignore that feeling. They use it. They recognize it as a warning sign. They know that when it feels impossible to sit out, that's exactly when you should. Because bubbles always pop. Always. Without exception. And when they do, the math reasserts itself violently. The greater fool theory. The social proof spiral. The narrative takeover. The math always wins. The rational herding. These aren't just interesting patterns. They're the anatomy of every bubble ever created. Understanding them doesn't mean you'll perfectly time the market. Nobody can do that. But it means you'll recognize the signs. You'll see the disconnect between price and value. You'll feel the social pressure but not be controlled by it. And most importantly, you'll know that when everyone tells you this time is different, it never is. the specifics change, the asset class changes, the narrative changes, but the underlying psychology? That's always the same. Because humans haven't changed. We still follow crowds. We still believe stories. We still think we're smarter than we are. We still hate missing out. And as long as those things are true, bubbles will keep forming and popping. Again and again. The question isn't whether you'll see another bubble in your lifetime. You will. Probably several. The question is whether you'll recognize it. Whether you'll have the courage to sit out while everyone else gets rich. Whether you'll trust the math more than the narrative. That's how you protect yourself. Not by being smarter, but by understanding the pattern. And once you see it, you can't unsee it.